Good evening, ladies and gentlemen. Welcome to our session today. Right, before I proceed, uh, when is your assessment?
The final one, I think, is on the 19th.
19.
Yes.
So, meaning by this day next week, you'll, so maybe you'll be left with 2 days next week. You are writing next week, Friday. Okay, so, someone says 25th of May. So, which day is it? Is it 25 or 19? So, should I say it's 25? Because I'm asking because I need to plan. There are things that I need to plan. Right.
Yeah, it's the 25th. So I was mixing with another model. Yeah, it's the
Okay, thank you.
25th.
So what will happen is maybe around the other weekend, I can organize a session during the weekend where we can be able to do something. Then in the meantime, I would like to ask you. I'm very sorry about it. To read on the things that there are things that I think you can always go through and look at on your own. That is the risk management. Can you just look at risk management? Maybe find time to read on risk management. Find time. I will then find maybe I will illustrate through some questions how to do that. So for now, I want to make sure that you know working capital in the capital budgeting. So our focus for today will be on capital budgeting. I think last time we're dealing with ratios, financial analysis. So we want to deal with capital budgeting, right? So we'll be dealing with capital budgeting. I'll be using some of the questions that I sent to you, right? What happens is a business, they usually evaluate whether they should invest in projects or not. They need to know if projects are worthwhile to invest in. Now we've got different methods that can be used to assess whether or not they can accept projects. We've got what we call the payback period. The payback period is normally used by risk averse investors. That means they are mainly interested in understanding when their money will be paid back. That is, when can they get their money back? So they would likely invest in a project that quickly gives them their money. Whatever happens later, it's something else, but they need to get their initial capital back as soon as possible. So that's the payback period. Then we can also use what we call the net present value. We can also use the accounting rate of return. We can also use the internal rate of return. So those are different methods that we can apply in an attempt to evaluate whether our projects or investments can be done. Remember that we are living in a world of scarcity. So you find that an entity does not have all the resources to do all the projects that they would like to do. So at the end of the day, they have to choose which ones they can do. That's why there is this investment appraisal, right? So today we'd like to see how to determine whether a project should be accepted or not. Uh, right. To help us illustrate, I've two papers that I've sent on your groups. So we would focus on question two on this 2020 paper. Would focus on question two. Right. Mm, right. So please, I will go with the concept slowly so that you'll be able to get what we'll be talking about. Right. We would start with part A. Part A is sort of a theory. It's sort of theory. Right. The first question asks us, I think I'll be guiding you considering that we didn't do these things. So I'll be uh, helping you to understand some of those things. Right. The first question says, name the traditional capital budgeting technique that is based on a project's average profit after tax divided by the average book value. Right. Then describe how this return may impact the decision making of the company. Right. We have got two traditional methods that are mainly used in evaluating projects: the payback period and the accounting rate of return. So the one that divides the average profit by the average book value is the accounting rate of return. So this method that they are talking about is the accounting rate of return. Let me just open this paper. Right. It's the accounting rate of return. That's the one that divides the profit. It's a percentage. Right. So then they just said, how does it impact decisions? Right. After calculating your accounting rate of return, which is average profit. Actually, let me just show you the formula. Average profit divided by average book value multiplied by 100. Then it doesn't end there. It then says, how does it impact our investment appraisal? Right. It then says, then describe how this return may impact decision making. Right. When you get it, you compare it to the required return. You compare it to the required return, right, or what we call the targeted return, right? If the accounting rate of return is more than the required return, then you accept the project. But if it is less, then you don't accept the project. So we're saying if the accounting rate of return is equal to or more than the targeted or required rate of return, the project will be accepted. But if the accounting rate of return is less than the desired return, then the project will be rejected. Right. So the project will not be accepted if its accounting rate of return is less than the desired return. Right. Any questions there? So it's just like the accounting net profit margin or return on equity. Right. Then the second question, it says define the profitability index and discuss the relationship therefore with the net present value approach. Right. This is the okay. Let me just we're going to calculate them, don't worry. The profitability index this is an investment in appraisal method which compares the present value of the future cash inflows to the initial investment. If the profitability index is more than one, the project will be accepted. If it is equal to one, the investor will be investing different. When we say is indifferent, we mean you will be on the fence. So you will have to consider other factors to know whether to accept or reject it. So you can either reject or accept it. Right. And if it is less than one, the project will be rejected. Right. Remember the concept of present value. That means you will just be expressing the future cash flows in terms of today's money. Remember the money that you receive in future, it doesn't have the same value as money that you can get today. Then they asked us to explain the relationship between the profitability index and the net present value. Right. If the net present value is positive, the project will have a profitability index of more than one. And it will be accepted. So you'd find that whatever decision that you can reach using the net present value method is the same decision that you will reach using the profitability index. They always give the same result. Because as long as your NPV is positive, then your profitability index will be more than one. Right. Then if the net present value is negative, the project will have a profitability index of less than one. And it will be rejected. So you'd find that whatever project is rejected under the NPV will also be rejected under the profitability index. That is for what we call independent projects. But we shall learn of what we call mutually exclusive projects, whereby you have to accept one project. So you find that now when you use the profitability index, they can give different results with the NPV if we are considering mutually exclusive projects. Right. Any questions? Right. We'll also calculate them at a later stage. Right. Number C, name the capital budgeting technique which depends mainly on the outlay and proceeds associated with the project and not on any rate determined outside the investment when calculating the actual rate of the project. Right, that's the internal rate of return. The internal rate of return just depends on we just use the inflows and outflows of the project. We don't have to use any rate. So that's the internal rate of return. I think we'll do it today. We'll see how to calculate that one. So it will not use any discount factor or any discount rate or any required return when it is calculated. Right, you will see what I mean, I think, today. Right, then number D is the following statement regarding the rate calculated by using the above method, true or false. This rate of return is the true interest rate earned on an investment over the course of its useful life. Right, it is normally taken as true that this is the true interest rate that is earned by the project over the useful life. So that's the actual interest rate earned by the project over the useful life of the project. So number D is true, because the internal rate of return, it gives you the actual return that we have obtained on a project. I think you will see it clearer when we do the question on that. Right. Then here now, that's where I want us to now understand those things that I've been talking about. Part B. So I now want to show you the methods. Tech Solutions Limited is considering purchasing an additional machine with special capacity to manufacture medical approved face shields for use by health workers. This machine will enable them to manufacture in huge numbers the much needed face shields that are in dire need as protective gear for health workers during the tragic COVID-19 pandemic. The following information for the face shield production machine is available. Cost price 2.7, depreciation per annum 900,000. Its realizable value at the end of the useful life 50,000. Estimated useful life 3 years. The estimated net income from the face shield production machine will be 1,990,800 during the first operation year. An 8% per annum increase in the net income is expected as from the second operation year. The current tax rate is 28%, and it is expected to remain unchanged during the period of the face shield production machine's useful life. The tax authority is prepared to grant an annual wear and tear allowance of 540,000 on the face shield production machine for tax purposes. Management requires 11% per annum after tax return on capital projects of this nature. All the cash flows except the initial capital outlays which occur at the beginning of the year, occur at the end of the financial year concerned. Right. First of all, I will answer the question. Then after answering the question, we have got different methods that we can use. We have got the payback, accounting rate of return, net present value, profitability index, and the internal rate of return. So first of all, I will answer the ones that are on the question. Then probably maybe on Monday, I will then show the other ones. So for now, we'll focus on the question as it is, but I will use the same question so that you see the other methods that I've just been talking about on the theory without illustrating them. Right now, it says number A, determine the net present value of the face shield production machine and advise whether the face shield machine should be acquired by the company. Right. Part B. A, calculation of net present value of the first suit production machine. Right. The issue is, if you invest in the project today, you only get your returns in future. But the problem is the value of money deteriorates over time. So if you invest 10,000 and you're going to get 20,000 next year, you cannot not just conclude that you're going to earn a profit, because the 20,000 that you might earn next year might be less than the 10,000 now. So the net present value method discounts future cash flows to their equivalent for today. So first of all, when we analyze the cash flows, we will then convert them to their equivalent in today's terms. Then we can see, does the machine give value or not? Right. So first of all, this is just for you. It's not for, I'm not answering the question here. You have to calculate the cash flows for each year of the project, starting from year 0. Right. What we call year 0 is today, when the investment is made. So under year 0, we record all cash flows that will be earned or incurred or paid at the very beginning of the project. That's what we call year 0. When we say year 1 now, those are the cash flows that will be received after year 1. So we then have year 1 up to the end of the project. In this case, it's year 3. So you have to calculate your cash flows. Then step 2, count the cash flows. Discount the cash flows to their equivalents. Then add up the cash flows, add up the present values, get your net present value. Right. I will illustrate so using the question now. So always you start from year 0. Year 0 is the investment period. Right. So dear VM, we'll have our year. That's 0, 1, 2, 3. Right. I want you to follow me here. Right. Right. I want you to follow me here. The cost price will be 2.7. That will be in year 0. We normally call it the initial investment. So you invest at the beginning of the project. So it will be in year 0. So always our initial investment will record it in year 0 unless told otherwise. So that will be negative 2,700,000. So if it's a payment, you show it as a negative. If it's a money coming in, you show it as a positive. So payments are shown as negatives, then receipts we show them as positives. Right. Then next, depreciation. Right. Depreciation is a non-cash item. Depreciation is a non-cash item. And it is not included when determining the net present value, profitability index, internal rate of return, and payback period. These methods, they only use actual cash flows in determining the value of the project. They consider depreciation to just be an accounting adjustment which does not affect the value of a company. All right, a depreciation only be included when using the accounting rate of return. This is the only method that will include depreciation. Right. Then realizable value at the end of the useful life 450. That means after using the machine for 3 years, they will then sell it for 450. So the realizable value will go on the final year. And they will be selling, so it will be money coming in, so it is a positive. It is a positive. Realizable value or scrap value is a positive. They can call it scrap value. That is the selling price of the asset at the end of its useful life. The 3 years is just to tell us the period under which we should do our analysis. Right, additional information. The estimated net income before depreciation and tax. Right. Number one, we don't need depreciation, so depreciation know what it's about it. Tax is included because you have to pay tax. But so tax will have to calculate the tax and include it. From the first shield production will be 1,090,800 during the first year, and 8% per annum increase in the net income is expected as from the second operational year. Right. So we'll have our net income excluding tax, depreciation and tax, if they said it includes depreciation, you were going to add back the depreciation. Remember that when calculating net income, we subtract depreciation. So to reverse it, you add it back. You don't subtract. So if they say it includes depreciation, you will have to add it back to reverse it. So in the first year, it's 1,090,800. Then we calculate for the other years. So we'll have our net income. Year 2 would be equal to 1,090,800 multiplied by, we are told that there's an 8% increase. So multiply by 1.08. What do we get? What do we get?
$11,780,000.
It can't be 11 million.
Sorry, no, it's not 11 million. Yes, but yeah, that's the number.
Oh, okay. It's
1,780,064. Yeah.
178. Okay, thank you so much. 064.
Yeah.
All right. Then we calculate for year 3. That will be equal to 1,178,064 multiplied by 1.08. Thank you. 1,272,309. Then here it's 178. Sorry, I think I made a mistake here. I put, it's not supposed to be on year 0, it's starting on year 1. Right. Then next you also have to include your checks, because remember they said it's excluding checks. Income tax expense. You have to do a calculation of checks. Right, when you calculate tax, you first calculate you pay tax at the end of the year. So we don't have year 0 in the calculation of tax. We don't have year 0 in the calculation of tax. All right. First of all, remember that from your tax 2601, that tax is calculated on the taxable income. So the first thing that we have to do is to calculate your taxable income. Right. We have the net income excluding depreciation and tax. That is this one that we got here. Right. Instead of depreciation, SARS will give you what we call capital allowances. There will be capital allowances according to SARS. There will be capital allowances according to SARS. Right now, our capital allowances. We are told that the tax authority is prepared to grant an annual wear and tear allowance of 540. So every year it's 540. It is subtracted. A wear and tear is the equivalent of depreciation according to SAS. Because you would find that sometimes, or in most instances, our policies of depreciation are determined by international accounting standards. But SAS have got their own way of determining wear and tear. So at the end of the day, when you calculate your taxable income, you don't subtract your depreciation. Instead, you subtract your capital allowances. Right. Then the next thing, you have to count when you sell the assets for 450 in year 3, there can be a profit or a loss. So we have to calculate that a profit or loss. And that profit or loss is not called profit or loss according to SAS. It's called recoupment or scraping allowance. Right. Our recoupment or scraping allowance is calculated as selling price or scrap value minus tax value. Tax value is what we normally call carrying amount in accounting. Right. And the tax value is equal to cost minus accumulated capital allowances. Now we remember that this machine was bought for 2.7 and the capital allowances were for 3 years for 540. So we'd say 2.7 minus 540 times 3, that would be our tax value. Maybe let me just write that this is our tax value. What do you get? $1,008,000. Then it is then sold for 450. So there's a loss, which you call scraping allowance, which you can claim from SAS. Which is 450 minus 1,008,000. What do we get? $60,000. So here we then have our scraping allowance. Negative in year 3. So we don't show the selling price. When you sell the asset, you calculate the recoupment or scraping allowance. So if this selling price was more than 1,080,000, it was going to be recoupment we're going to add. Right. Then you get your taxable income. By adding up each column. Then you get your income tax at 28%. You should check if they are using 28%. Normally for this module, they've always used 28%. But considering the changes that are happening in the tax rate, you should always check if on the question paper they're saying 28%. Right. 20%. Right, thank you so much. I calculated them using Excel. So these will be our tax values. So you then export them to your calculation here. These are our tax expenses. We then subtract. So make sure that here you subtract capital allowances and not depreciation. So that will be the income tax expense. Right. After recording everything, then we get what we call the net cash flow. You add up each column. This will give you the net cash that will be earned or paid by the company. That means in year one, we're going to pay out 2.7. Then in year two, get 936. Year three, 999. Year two, sorry, 999. And year three, 1,693,000. Any questions so far? Right. Then we discount these figures here. They will be received in future. We have to convert them into their today's equivalent. And to do that, we use the required return. Now they say that the required return is what? Is 10%. All right, 11%, sorry. So the required return is 11, maybe let's say discount factor at 11%. So you go to the tables, table A, you get the discount factors for 11%. In year zero, it will always be 1. Then they will be at the end of your question paper normally. These are the present values that you get here on the table. So you go on 12% and you take these 3 for each year. Sorry, 11%, isn't it? Sorry about that. It's 11%. Right. So you take them here on the, oh, we don't have, they were not given here. So you were supposed to calculate most. There's no 11% here if you can see. Right. To calculate, let me just show you discount factors. Year 1 would be equal to 1 divided by 1.11 to the power of 1. What do we get? Is it the 0.896? Then year 2 would be equal to 1 divided by 1.11. The 1 is coming from the percentage to the power of 2. The power will be the year. If I need 2, it will be to the power of 2. Year 3 to the power of 3, on and on like that. What do we get? But if the percentage is on the tables, don't worry about calculating. You just go to the tables and take them on the tables. What do we get? I'm waiting for you. Let's be fast, guys. Are we stuck?
0.81162.
0.81162. So we can say 1, 2. Here 3. 1 divided by 1.11 to the power of 3.
0.73119. 0.31.
Yeah, right. I just use three decimal places because those are the ones that they use even on your in your tables. Right. So is year 1 changing to 901? Can I change to 901 the year 1? I had been given 0.896. And I see that Sina is given me 0.901. Should I change? Can you just, okay, thank you for confirming. 901. Right. So to come here and enter those discount factors 0.901, 0.812, 0.731. What is the meaning of this? It means that 1 rand received at the end of year 1 is equivalent to 90 cents today. 1 rand received at the end of year 2 is equivalent to 81 cents today. 1 rand received in year 3 is equivalent to 73 cents today. So we then have to convert now these ones according to these discount factors to find what we call our present value. We multiply. So it will be this multiplied by this one. We do the same for all of them. So we're saying this 936, which we receive up in year 1, in today's terms, is equivalent to 843. The 999, which we receive in year 2, is equivalent to 811 today. The 1.6, which we receive in year 3, is equivalent to 1.2 today. That's the meaning of present value. That's why it's called the net present value. Then to get your net present value, you add up the present value. So the total of this will be our net present value. So we can say equal to sum. You add them up from year 0 up to the last year. So that will be our net present value. And if it's positive like this, as long as you are evaluating one project, then you accept the project. But if you are evaluating many projects and they are what we call mutually exclusive, when we say mutually exclusive, that means you can only accept one. Then you have to take the one with the highest NPV. If you are comparing many projects, you take the one with the highest. But in this case, it's just one project, so we'll take this one as it is. So then they said and advice whether the face shield machine should be acquired. So our advice is that the conclusion, don't forget the conclusion or advice. So our advice is that they should buy the machine. We say the face shield machine should be acquired. As it will result in a positive net present value. That's what will happen. Any questions? All right. Now I want to give you homework. I want you to try to calculate the payback. When we meet on Monday, I would like us to calculate the payback. Then we'll start from that payback, and then we'll also do the internal rate of return. Then we'll also do the accounting rate of return using the same question, so that you appreciate the different methods. Any questions? Okay, if you don't have any questions, then we'll meet next week. Thank you so much, and God bless you richly.
Thank you. Bye.